So we're diving right back into it, Urs, with the Swiss view. We have a new president-elect in the United States. Markets have been euphoric, certain markets, maybe not others. On the same day that President-elect Donald J. Trump was elected, the German government fell apart. I think we should really just dive into kind of looking at the economies around the world, kind of what's happening in Europe, what's happening in the States, and try to give a picture of, you know, why things are happening the way that they are.
Yeah, I mean, in Europe, there is a lot going on that doesn't look very promising. We have a government crisis in Germany, as you just mentioned, where Olaf Scholz fired his finance minister. Then we have a crisis which intensified just this week in France, which was already expected to a certain degree, where Michel Barnier has been let go, more or less, and where President Macron has to find a new person to head the parliament or the government. And then on top of that, we are still having the war in Ukraine, which is putting pressure on Europe. And I think that as bad as it looks like, you also see how people are looking for change, are looking for politicians that are more in their like on their side and give back the power to make decisions, also the power for the economy to grow. And so in midst of all this negativity, I believe that Europe has some hope, Europe has some potential and has a vision to go and to move forward.
Yeah, and I think especially when you look at kind of the underlying economies, they've been in a really challenging situation, I'd say, for about 3 years. And they were really kind of starting to crawl out of it. And then there was this real disruption, I'd say, in the government, especially the departments that were kind of facilitating it. I mean, you'd seen Italy that was doing fairly well is now kind of starting to feel the burdens of the rest of Europe catching up. I mean, if you look at Switzerland in the midst of it, it's an interesting picture because, I mean, their GDP growth rate this year is running at about 2% growth, which for Switzerland is pretty decent. I mean, especially when you look at their major trading partners being Germany and France and even Italy as well. They're kind of right in the middle of this turbulence, but seemingly pretty strong. I mean, inflation is down below 1%, I think right at about 0.6, 0.7. Yeah. So and they've got inflation under control and aren't fighting that. If anything, they have to be a little bit cautious of it not going too much further down or hitting too much deflation if that were to come. Their unemployment rate is under 3%. It's like 2.6%, I think.
It's 2.5.
2.5, yeah. But I mean, really great unemployment. And, you know, it's comparing Switzerland to some of these much larger economies can be tough, but at the same time, it shows how they can manage their currency that stands, the free floating currency in terms of what it does. Its stock market, its market players. It's very interesting to see everything in the economy looking mostly good except for the sentiment. Right. Which is very negative in Switzerland, which is kind of interesting. And I think part of that is when they look around at the broader scope of everything in Europe, they think, okay, when is this going to hit us? Right. And the challenges that they navigate. But so far, they've been able to navigate them quite well.
Yeah, and it's not only Europe. It's also when you look abroad or like further around, you have China, which is still struggling. You have South Korea, where we also have a government crisis. Yeah. You have also the US, where the official numbers look very good, but you still have underneath, and that is something we have covered in the past, you have certain developments that are to some extent worrying. And so I think with the very conservative approach Swiss people or the Swiss culture has, people want to be on the safe side. So they want to save their money. They want to make sure that they have enough if times really get worse. And I think that there will be a point where we will hit the minimum, the bottom, and where it will shift up again. But there has to be some kind of an indicator, as we have seen in the past.
Yeah, and I think the challenge that you see, especially as you talk about the United States economy, most of the numbers look pretty good. Mm-hmm. There is this feeling that it's unwell.
Right.
Maybe that there's some medication going on, and I would argue a lot of the money that was poured into the economy 3 years ago and continually poured in over the past 3 to 4 years is that medication. I was talking with a financial advisor from the States this week, and he was saying, yeah, if you're upper middle class or above, you're doing great. Why? Well, the stock market's great, money is flowing into it. We see this in euphoric growth there. But if you look at the other part of the United States, it's wrecking them. Inflation is still above the target.
Mm-hmm.
PCE is at 2.6%, 2.7%, so higher, getting closer, but higher. Inflation year over year, core is 3.3%, so still quite a ways away from where they want it. I mean, there's still a lot of these things that can really drag the economy happening. Government spending doesn't seem to be slowing down, doesn't seem like it will be slowing down as part of this symptom. And I think that creates kind of this weird position of the stock market's doing great, not all sectors, which I think you want to get into after this in the US, looking at the S&P 500, but the economy is all right. But what happens if this little tummy bug turns into a full-blown virus and actually starts affecting the economy?
Yeah, and I think the point you made about the stock market is also interesting. I mean, if you look at the S&P 500, it is up, what, 25, 26%. I mean, it's crazy, but 1/3 of the performance, more or less, is because of NVIDIA. And if you compare the performance of the index and then the performance of the retail investor, the average retail investor in the US, I mean, the performance of the average retail investor in the US is around 5, 6, 7%. So that's a gap of about 20%. And there you also see it has started to move apart from each other somewhere in July, August, where people really started to feel, okay, something feels wrong. So we don't really trust the numbers. And I don't make the statement that the numbers are wrong per se, but it's just what they're experiencing in their day-to-day life is somehow different than what the government tells them what they should experience.
Yeah, and not just the government, but the media talking about, hey, everything's going up, everything's great. And I think that obviously creates some uncertainty, of course. And I think even with governments changing, people don't really know exactly where regulations are going to go, where investing is going to go, and is this euphoric market feeling at the moment, is that realistic? Will the policies come in that actually affect those things? How impactful will those policies be? Will this dragging government debt, will this incredible amount of liquidity on the markets actually turn into something that's going to hurt? And I think from our side, looking at the global perspective, I mean, even in Germany, we see stock markets going up. Switzerland, less of a picture, more stable, still up, but not at the same extent that the US maybe is. And it's interesting to see, okay, how much can we extrapolate? Is that from the investor sentiment? Is that from performance? Are the investment managers at institutions making the wrong decisions? Are they too cautious? Are they worried? What is their kind of feeling? I guess from your perspective, where do you kind of see that, especially in Germany and kind of Europe, where we see Germany's stock market up, but France at the other side is down?
Yes.
Where do you what do you pull away from that?
I think that especially when it comes to Europe, investors are very cautious. And then on the other side, we have had the election in the US, where there has been a huge shift of money, of liquidity moving into the US. But that leads to a situation where you also have to look at the valuations of the indices and of the companies. I mean, the market capitalization of the US stock market is 230% of the GDP. And that's huge.
Massive.
And the valuation is so high. And then at the same time, you look at Europe, where the valuation is low. It's at the 20-year low. And so the question you have to ask yourself, maybe, are you going to chase the last 2-3 percentage points in the US, or are you going to position for the next 3 to 5 years and move to Europe? And that is also something we see once the markets are going up in the US. There is much more liquidity than what we see when the market is coming down. And so there is some repositioning within, I would say that there is a term smart money, but there are some institutions, hedge funds, family offices moving more to Europe. I have also talked to different lawyers this week who helping Americans to set up their investments in Europe, and there is some interest because it is cheap. But you have to have this time horizon to not just chasing the last 2-3 percentage points, but to have a strategic decision you make to cover a certain area in the prospect of what the future brings.
Yeah, I think that's a really good point. And when you get into the whole fear of missing out, greed,
Yes.
Whatever, or fear of loss,
Yeah.
It kind of stems to greed either way. I'm greedy. I don't want to lose what I have, so I'm fearful, or I don't want to miss out, so I'm greedy for those percentage points. I want to be a part of this boom, and that's always something that investors have to really deal with. We ourselves have to. We have to make sure that we're in communication as a team to make sure that we're not letting that affect us too much here or there, but actually sitting down and making informed decisions. And if there's a good decision made, taking a breath, realizing, okay, what did we do right there? Was it luck? Was it good evaluations? Was it the right decision at the right time? Understanding the trends. If there was a bad decision made, take another breath. Okay, maybe there was some mistake made. Where can we see that? Or maybe it was just unfortunate. Maybe it was also luck. But making sure that when you make a decision, you educate yourself before you make the decision. If you make the decision, goes well, great, keep educating yourself. If it doesn't go well, educate yourself further and then make another decision. But don't just make decisions here and there based out of emotions. And I mean, especially as we see bond yields, the yield curve inverting, I mean, this causes a lot of economists concern. But looking at the bond markets, they look pretty interesting as a lot of bonds hit maturity, and now there's this refinancing of debt for companies. What do you see, I guess, in comparison to the US, where everyone's chasing these high yield bonds versus kind of Europe corporate level bonds or global bonds?
I mean, the bonds, they become less interesting again to a certain level, but there is a difference between the corporate bonds and the government bonds, and especially on the fixed income side or money market side in the government area, you see that yields are increasing to a certain extent and that spreads are increasing. And there is some, not only in Europe, but also in the US, where investors say, okay, look, there is a certain threshold. We don't really want you to go above it when it comes to government debt. And we see it with the US, where the government debt is probably going to increase further. And we see it in France and in Germany. And investors don't really have such a great issue with debt, with government debt, as we could see the last 13, 15 years. But it becomes an issue once the increase in debt is not supported by the economic growth.
Yeah.
And that's where we see ourselves right now.
Yeah, absolutely. I think that's a really good point to bring up. So moving on from that, we've got US dollar, very strong in relative nature to where it has been in the past, I'd say 12 months. We have Bitcoin flying through the roof, and gold levels this year were all-time high after all-time high, kind of petering out a little bit. I'm not saying that they're done. I'm not saying they're going to go all the way to the bottom. Could you kind of give, I guess, a picture of the US dollar? I mean, we've seen it getting stronger against a lot of currencies. I mean, the Swiss franc, everything. But for me, the interesting fact is, even if I drop back 2-3 years ago, the US dollar is weaker against, as an example, the Swiss franc. 3 years ago, even with its uptick in strength, it's still not stronger than it was before.
Yes, I mean, against the Swiss franc, it's an interesting story over the long term that the Swiss franc already has proven itself and has strengthened against the US dollar. There are some other currencies. The euro is struggling a lot, and that has a lot to do with the war and the government crisis. But I mean, in general, the current strength, I would say, is very much emotionally driven, as is the inflow of money into the US stock market. And it is not something where we see a sustained trend of a strengthening US dollar. And as far as we are concerned, and as far as we hear and recognize what the US governments and presidents are saying, they are not really interested in a strong US dollar because they want to become more of an exporter than an importer, and therefore a weaker US dollar will suit them better. But it does have an impact, obviously, also on the gold price. A strong US dollar usually puts pressure on the gold price. But then also on top of that, if you have more euphoria, yeah, there we go. Euphoria in the stock market, there is also less interest in a commodity like gold. And so we have seen gold taking a hit to 1550. Now it's back to 1650. It has been above 26. That as 2650, yes. Yeah. And it was 2550. So, but I don't think that US dollar will stay as strong as it currently is.
Yeah. So you kind of you think long-term perspective, as I take this tack, that the US dollar will long-term continue to devalue. But do you think then in that situation that gold will then kick up in value as the US dollar devalues, or do you think that it will kind of remain steady?
That's a tough question. I mean, if we look back to where we have been in 2010, 2011, gold reached an all-time high. The US dollar was strong, and then it started to weaken. And there was a lot of support in the economy, also from the central banks. And so I think if we're moving into a certain or into a similar direction as we have back then, there is also a case that gold will not perform as well for the next 5-6 years. But it could also go the other way around. I mean, we still have a lot of hotspots around the world geopolitically. We have this tariff threats, and so there is a reasoning for both, and the consequence of that is you really should stay diversified.
Yeah, agreed.